Hey everybody, we're going to talk about one of my favorite stocks. It's one of my top 10 stock positions. It's an insurance company, and it's one that I think really has a lot of long-term potential. I know the phrase "the next Berkshire Hathaway" gets thrown around all the time, and there are some natural fits for that, like Markel. But this is one that definitely I think should be in the conversation of one that has a lot of long-term potential, both on the insurance side and on the investment side. So before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. You get the top 10 stocks to buy right now. It's the best way to support this work I'm doing, and you can get a lot more great stocks like the one I'm about to talk about. Again, fool.com/Frankel. So without further delay, the company I'm talking about is called Kinsale Capital Group. Ticker symbol is KNSL. They're an insurance company, but they're not the type you would call if you need auto insurance, if you need homeowners insurance or anything like that. They are a specialty insurance company. This is known as the excess and surplus lines, or ENS, in the insurance business. But generally, this is a company that writes insurance policies for things that mainstream insurance companies won't touch. If there's a particularly high-risk business, let's say you wanted to open a demolitions company, a traditional liability insurer might not want to touch your business. If you were going to open a business in kind of an unknown industry, kind of like, let's say, like a cannabis distribution facility or something like that, something that just does not have a lot of data about how risky it is, that's something you might need to go to a specialty insurer for. And that's where Kinsale comes in. Both of those are actually pretty big parts of their business, risky businesses and unknown or new businesses, I guess you'd call them. They focus on smaller accounts. That kind of gives them an edge. They are one of the only companies that is purely focused, and the only company in the public markets that is purely focused on this type of insurance. So let me share my screen real quick. I want to just show kind of the track record so far. They've been in business since 2009. There we go. And you can see that just the record of execution so far has been fantastic. We'll talk about why in a little bit. But if you see this, every year, Kinsale has produced positive returns. It's beaten the S&P 500 in all but 1 year, 2021 right there. And over time, investors have been handsomely rewarded. These are like early day Berkshire returns. Not to overuse that comparison, but that's a pretty impressive track record of growth. I don't expect them to sustain that year after year after year forever. The numbers would just get too big. But this is still a pretty small company. It's about a $10 billion market cap and still has a lot of room to grow. So again, only pure play specialty insurance business in the market. And here's why they've been so successful. So insurance companies, to evaluate them, you need to know a metric called the combined ratio. This tells you how profitable the insurance company's underwriting is. And there's two components to combined ratio. There's what you call the expense ratio, which is the expenses of running your business, administrative costs, things like that. Then there's the loss ratio. That's the percentage of the premiums that you collect that you pay out for claims when somebody files, an insurance claim. Combining those together, which is why it's called the combined ratio, tells you your total costs relative to the premiums that you're collecting. Subtract the combined ratio from 100, and you get your underwriting profit margin. So 100% combined ratio, in other words, would mean that you simply broke even on underwriting. Insurance companies, of course, make their money in two ways. They make their money from hopefully from profitable underwriting, and also from investing money that they've taken in but have not yet paid out as claims. This is known as the float. This is where how Berkshire Hathaway has so much money to invest because they're an insurance business. They have Geico and a few other insurance companies. And so they make some money off investments that way. We'll get to the investment part of it in just a bit. But in here you can see these are all of Kinsale's kind of most direct peers along the bottom right here. This company, JRVR, that's James River Insurance. That's where Kinsale's CEO came from originally before he left to start his own business. So the kind of key takeaway, and this is from 2021 to 2023, the average of its peer group has a combined ratio of just under 93%, which implies an underwriting margin of about 7%. Kinsale's combined ratio in that same time was just over 77%, so almost a 23% underwriting margin, several times greater than its average peer. And it's not just that its losses are lower. In fact, you can see a lot of these companies, the losses are comparable or even lower than Kinsale's. These two right here are lower. Kinsale's loss ratio is 55.1%, meaning that for every $100 it takes in for premiums, it's paying out about $55 to cover insurance claims. The real advantage here is the expense ratio. Kinsale's average is 22.1%, and that's dramatically lower than any of its peers. That is a technology advantage. Kinsale is a pure play on specialty insurance. It's all it does. It develops its proprietary technology to underwrite policies that cuts down on things like administrative costs and things like that and gives it a big cost advantage. So this cost advantage here allows Kinsale to price compete with peers in terms of pricing insurance policies while still remaining much more profitable than any of its peers in this group. So that's why the company's been so successful. That's why it trades at a big valuation, by the way. If you look at Kinsale's valuation relative to its insurance book or policies in force or anything like that. That's why. This is a big potential company. So the specialty insurance market is surprisingly huge, almost $100 billion of annual premiums. Kinsale has about 1.1 billion of that, so about a 1.1% market share. There are some big players in the space that generally focus on bigger accounts. Lloyd's is by far the biggest specialty insurer. Berkshire Hathaway is number 2. AIG and Markel are both on the list. They're both big specialty insurers. Kinsale is the 21st largest specialty insurers, and all of the smaller companies make up more than 50% of the market. This is a big fragmented opportunity. And although when you hear the phrase that it focuses on smaller accounts, it might sound like it has very limited opportunities going forward. That is not the case. Small accounts actually make up the majority of the specialty insurance market. And last but not least, let me talk about the investment portfolio for a second. The company has, like most insurers, right now a pretty boring investment portfolio. About 91% of it is made up of bonds, fixed income securities, most of which are very, very high quality. And that's how it should be at this stage of the game. But right now, Kinsale has about 9% of its portfolio invested in equities, and more of that has started to shift into equities. This percentage was much, much lower just a couple of quarters ago, and especially a couple of years ago. And Kinsale's CFO, Brian Haney, has recently said that they are starting to get more comfortable as they start to scale to shift a little bit more money into equities, and we're starting to see that. So point being that over time, we could see Kinsale's equity portfolio really start to build up. So it could start to build up a stock portfolio, which is why I think it actually deserves a bit of a comparison to an earlier stage Berkshire Hathaway, at least more so than people seem to give it credit for. When you hear the phrase early Berkshire Hathaway, you generally think of companies like Markel. That's usually what people cover. But some other insurers are getting a little more comfortable putting money into investments. They see that this model works to kind of boost returns and things like that. So this is definitely worth watching going forward. I can see that this equity thing is going to get a little bit larger each year, especially as the business scales. If Kinsale can double or triple its market share over time, it could become a much more equities-focused portfolio than it is right now. So I'd love to hear what you think. Do you own the stock? Do you think it's too expensive? Do you have any concerns about it? Well, I'll do my best to answer any questions or comments individually, but thanks for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.